Welcome to Alibaba, the place that keeps on giving us all a headache. Yes, Alibaba, the stock that keeps on dropping. It just doesn't want to seem to go upwards. Why is it? Is Alibaba a stock to buy? Is it an absolute value steal or is it a value trap? Well, we will find out today as we look at Alibaba. We're gonna do a deep stock analysis looking at key metrics in terms of revenue, net profit, earnings per share, PE ratio, assets versus liabilities, the free cash flow, shares outstanding, and so much more. And then if you stay to the right to the end of the video, I will give you the intrinsic value of Alibaba, where it is currently in terms of Graham's calculator, and then I will give my own synopsis of what I think the true intrinsic value is right now. And you obviously will have to factor in that the US versus China has always been a volatile thing, and there's talks that China is starting to go sideways, but it's still one of the biggest probably the biggest middle class growing group in the world. So look out, China's on its way. But let's get to it. Alibaba, stock analysis and intrinsic value. Welcome guys and gals to the channel. In this episode, we're going to look at this Alibaba stock and have a look at what the key metrics are. Well, first of all, what is Alibaba? Well, everyone's just saying it's a commerce site. Well, you pretty much, the best way to sum it up, it is the China's version of Amazon. That's the easiest way. They have recently split into 6 different groups. We've got Cloud Intelligent Group. We've got the Tabo Small Commerce. Then the global digital commerce side of it. So you got the local one and then the global one. And then you look at we've got the logistics side, we've got the digital media and entertainment, and the local service group. So there's the 6 groups that they split into. So obviously you got the logistics, which is big for Amazon, which is big for this company. But as Cloud Intelligence Group, this is something that they really need to work on, just to give you a bit of a heads up, folks. Cloud Intelligence Group is not the biggest in China. It will need to really grow if it wants to get to the top of the table there. And that's something that's not actually helping the business. So that's probably why it's lagging a little bit, because when you compare it to Amazon, it's absolutely making them all the money in the world. Well, let's get to it. Yes. Alibaba's revenue in 2022... or just into 2023 as well, it's 126 billion, up from 56 billion in 2018. So in terms of that, it's a double up, so that's good. But it's been trading a little bit not so good. It was not that good last year. 2021. So it was higher in 2021. So they really need to get going on the revenue and continue to build this business over time. The net profit as well, bit of a disappointment too. 10.5 billion last year, from 22 billion in 2020, so they've halved their price. So that's why the stock price has gone down. If your profits are going down big time, no good. But the earnings per share is still very good at 9. And then you got the PE ratio, 9.7. So this company's got no growth in it apparently. That's what you got to decide at home. Is the PE ratio 9.7 really where it's at? If you look at Amazon and all the other big companies, way higher than this. So Alibaba is treated like a stable stock, where you got to believe there's more growth in this company. If you believe in that, then you'll want to stick around for the end for the intrinsic value. There's no dividend on this stock. Similar to Amazon, probably a long way away before they introduce a dividend, as they continue to try and grow the business. So one of the positives that this company has in Alibaba is the assets. 244 total billion assets, yes, total, compared to 86 billion in liabilities. But the liabilities have gone up from 61 billion in 2019, so it has been going up instead of going down. But in terms of ratio, 3 times more assets to liabilities, it's a very good thing for this company. Now, where the company's not going so favorably is free cash flow. From the $126 billion, they can only have 6.4 billion in net cash left over, which is a drop from 11.8 billion. So this is something the company needs to work on, is the free cash flow, because the long-term debt of 22 billion, which is not super big, but it's still 20% of your revenue as currently. There's some work to do there. But the long-term debt has increased too, from 17 billion in 2020, so up 5 billion in a couple of years. So not good. But on the positive side for you Alibaba shareholders or potential shareholders, the shares outstanding has been decreasing over at least the last couple of years anyway, from 254 billion from the 2.71 billion in 2021. So that is a positive for you out there, that the share, they are not diluting you. They were in the past, but right now they're not diluting you. So that is a positive for you as a possible investor in Alibaba. This is not financial advice. To do your own research before you buy into any stock. So what does Alibaba need to do to improve? Well, first of all, the cloud company needs to get going and really start amping up there. They really need to get that. They're booming. The e-commerce side has slowed down. Are we going to see an increase and a boom? They were hoping for that. They need that to increase and to continue to boom for them. Logistics is always going to be a big one for them. They should continue to be a decent money-making machine for them. The digital media side, this is something that they've done some collaborations with. This is a work in progress. Can they make sure that's a decent long-term profitability thing for this company? That's going to be big. And obviously the e-commerce and the global and current status, they need to lift up and improve their overall profits. So, I mean, the profits at the moment is 5%, which is not good enough. They really need to push that up to get themselves going. Similar in the sector today, to be honest. So it's not a bad thing, but it's just something that they could work on to get themselves better. So let's have a look at the intrinsic value of this company. So we're doing the grams calculator here, just a simple calculator. Just gives you an idea of what the stock is, which you can find on Trade Brains if you want to check up the calculator. So we're going to go Alibaba at $88 a share. For this example, the earnings per share roughly currently is $9 with a growth rate of 5%. We get an intrinsic value of $173. So it's pretty much, not quite, but pretty much a double up from here if you're expecting to only grow 5% from here. So if we put that up with the same metrics with 10% growth, then we're looking at $267. So this looks like a steal deal of the century. And then if you want to really ramp it up and say they're going to hit it out of the park and they're going to double their earnings per share to 18 at a 10% growth, then this stock is double that at $534 a share. Wow. All the metrics say that Alibaba is a stock to buy, not financial advice. But over the long term, I would say this company is an absolute steal deal at this price. Do your own research before you invest into anything. But at this stage, Alibaba, if I want to give it an intrinsic value roughly currently, I'd probably say about 200 is the intrinsic value. But when you cut in a little bit of the the China difference, they don't like the China companies per se, then you're probably looking at their growth rate of $173 a share. Just something like that. But in terms of what is truly valued, around 200 in my opinion is where the stock is currently. So you can easily double your money. But you could be waiting a year or two, even longer. You've been waiting a long time if you've been in the company for a while. I am not a shareholder, and making that clear, I'm not a shareholder. But anyway, that's a stock analysis intrinsic value of Alibaba. I hope you got a lot out of this and have a great day.